Ekta, this is the first signs of a slowdown in some of the European subsidiaries. The pace has been very good up until now, but in this quarter, we are seeing a significant drop in their margins on a quarter-on-quarter basis. Now, SMR, which is one of their biggest subsidiaries in the rear-view mirror business, has seen a big drop in their margins quarter-on-quarter. This time, SMR has reported margins of 9.1% versus 12.5% that they reported last quarter. 12.5%, remember, was a record high, and that has dropped to 9.1% this quarter. Also, the sales growth for SMR has slowed down to 6.5% year-on-year, coming in at 374 million euros. The other subsidiary, which is SMP, over there as well, if you look at the sales growth, it's fine. 13% sales growth is what they've reported. In SMP too, their EBITDA margins are not getting above that 7% mark. It's been in 6.5 to 6.9% for the last many quarters, so there's not too much of a growth that we're seeing over there. Even if you look at the consolidated EBITDA growth, it is lower than what the street was factoring in. The street was expecting about a 28 to 30% consolidated EBITDA growth. The numbers have been restated, but even on the restated numbers, the EBITDA growth is just 20%. It's a good growth, but much lower than what the street was anticipating and much lower than the company's own track record for the last many quarters. Another negative internal is the fact that the debt has increased for the company. We were expecting this to happen, but the net debt for the company has gone up 8% quarter-on-quarter and now stands at 4,632 odd crores. So many negative internals coming in, but the biggest one really is the fact that their key growth engine, which is SMR, this time has disappointed with a big fall in its margins. And the stock, as we know, has run up a whole lot. So the margin of error is also very, very limited for Motherson Sumi.